Thank you very much, Fred, for that very kind introduction to members of Congress, representatives of the United States government, members of the diplomatic corps, distinguished guests, ladies and gentlemen. Fred just mentioned before that I'd spent some time at university studying Chinese. In the great tradition of things, once I graduated back then in the early 1980s, I then was basically unemployable if you graduated with Chinese back in those days. So there was only one career possible, which was the Australian Foreign Service, which is where I then, by the way, met Ambassador Richardson. He was my first section head. I spent my time doing his photocopying. And later I graduated into collating. And then, just as I was about to be promoted, coffee. And our roles basically haven't changed since then. And Dennis is a great ambassador of Australia here in Washington, D.C., and a distinguished Australian diplomat. The great thing, though, about the Foreign Service, I'm sure it never happens in the US Foreign Service, that when you graduate, when you enter the Foreign Service and you speak a language, and for me it was Chinese, they then look at you carefully and say, right, we've got the perfect posting for you, it's Stockholm. And I don't know if you've been to Stockholm recently, there's not a lot of Chinese spoken there, but in fact, when I went there wasn't even a decent Chinese restaurant. And then, a few years later, when you have enough Swedish to make a decent lunchtime imitation gag of the Swedish chef on The Muppet Show, just by that stage, when your Chinese are starting to rust out, they say, now we're going to send you to China. Well, I'm sure it never happens in the US Foreign Service. You're a more rational organisation than ours. Maybe not. Fred, I'd really like to thank the Peterson Institute for the invitation to join you today in these immensely challenging times for economic policymakers right around the world. Today, we face virtually unprecedented challenges, and unprecedented challenges demand unprecedented responses. Nearly 6 months ago, on my last visit to Washington, I attended the first G20 summit on the global financial crisis. 6 months later, I'm on my way to London to attend the second. Last November, I observed that the unfolding financial crisis would soon become a crisis in the real economy, which would in turn become an employment crisis, and then in certain states, a social crisis, and then in some, a political crisis. Nothing has changed my view since then. The forecasts for the global real economy in 2009 have been revised down 4 times in the past 6 months. The International Monetary Fund now forecasts a contraction in global GDP of between 0.5 and 1% in 2009, the first contraction since the war. Advanced economies are projected to contract in 2009 by between 3 and 3.5%, including a contraction here in the US of 2.6%. Just this week, the World Trade Organization forecast global trade to fall in 2009 by 9%, the first contraction in world trade in a quarter of a century. While estimates vary, a 10% fall in trade could reduce global GDP by up to 4% over time. And the consequences of this growth slowdown for employment are severe. Given the dramatic slowdown forecast for 2009, the number of unemployed worldwide could increase from 2007 levels by up to 50 to 70 million people by the end of 2009. Against this dramatic backdrop, the leaders of the Group of 20 nations are meeting in London next week to coordinate a global response to this continuing global crisis. The challenges are great, the urgency is great, the obstacles are substantial. History reminds us of the consequences when nations fail to work together. 75 years ago, 66 nations met in the depths of the Great Depression at another London conference, the World Monetary and Economic Conference of 1933. Yet despite high expectations, the 1933 conference failed to deliver a cooperative approach to tackling that crisis. Instead, the conference collapsed amid recriminations which led to growing protectionism and a slowing of general economic recovery. Writing of the 1933 London Conference, H.G. Wells concluded that, and I quote him, "If Versailles produced a monster, London produced nothing at all. Never did so valiant a beginning peter out so completely." None of the participating nations failed to grasp the gravity of the moment at the 1933 conference, the importance of fighting the Great Depression. Despite the participants having what, again, H.G. Wells described at the time as a, and I quote him, "stout determination to be brilliant," unquote, the conference ended as a failure. Faced now with this global financial crisis, this global economic crisis, we must ask ourselves what lessons that conference holds for next week's meeting of the G20, again in London. Historians often blame the failure of the 1933 conference on President Roosevelt's insistence on putting the economic priorities of his own nation before that of the world economy. But the great historian, Arthur M. Schlesinger Jr., suggests that the blame is better shared among all key participants. Fundamentally, that conference floundered on the inability of the three great Atlantic powers, the United States, Britain and France, to agree on joint policies to stabilise their currencies. A currency stabilisation approach having failed, Secretary of State Cordell Hull tried to deal with the looming problem of protectionism. Hull failed. And he later observed, and I quote the then Secretary of State, "In general, each country advocated the abolition of reduction of all barriers to its commerce, except of kinds which it itself was practising," unquote. Nothing much has changed under the sun. The 1933 experience contains important lessons for us today as we prepare for another great conference on a crisis in the global economy. In 1933, every nation put its own national interests first. As a result, protectionism continued to rise, international trade fell, and economic recovery was delayed. But the truth is, paraphrasing the head of the World Trade Organization, Pascal Lamy, the problem with protectionism is that protectionism doesn't protect. World leaders today are challenged through the forum of the G20 not to repeat the mistakes of the London Conference of 3/4 of a century ago. The G20 has begun to act as a global political clearinghouse for coordinating global action to address this global crisis. Its legitimacy, the legitimacy of the G20, and its potential effectiveness in this role comes from the fact that the G20 reflects the growing realities of the new global economy, bringing in China, India, Brazil, and other emerging economies to the table. The G20 brings together economies comprising 90% of global GNP, 85% of the world's banking system, 80% of world trade, and 2/3 of the world's population. The body also represents genuine geopolitical diversity, with 5 economies from the Americas, 5 from Europe, 5 from Asia, and 5 from elsewhere. And the G20 already has a track record of success, having delivered practical cooperation at the finance ministers' level since its creation in 1999. Much work, however, remains to be done. Every nation right now is working hard to cushion itself from this global crisis. In Australia, our economy is in a relatively strong position. While through the year to the December quarter, all G7 economies had recorded negative growth, Australia's through-the-year growth to the December quarter was positive at 0.3. Australia's economic growth remains among the top 7 of the advanced economies, though in the last quarter of last year we dipped negative. In 2009-10, Australia's net public debt is projected to be 1.4% of GDP, around 30 times less than the projected OECD average in 2010 of 48%. And Australia has the lowest budget deficit when compared with the deficits of the G7 economies and one of the lowest in the OECD. Australian banks make up 4 of the world's 11 major banks that still retain a AA credit rating. The Australian government has acted early and decisively to deal with this crisis at home. First, the government has acted to maintain the stability of our own financial sector. Last October, the government took the unprecedented step to guarantee all Australian deposits and the term funding of Australian banks. Second, the government has pursued an active policy of macroeconomic stimulus, again designed to support growth and jobs until the private economy recovers on the back of recovery in private credit markets. The government's fiscal stimulus measures represent 2.4% of GDP in 2009, 1.4% of GDP in 2010. The quantum of the government stimulus action is broadly in line with the IMF's recommendation of 2% in each of the years 2009 and 10. The third part of our strategy is a medium-term framework for fiscal policy, to take action to begin returning the budget to surplus when economic growth recovers to above trend, then to use surplus funds to pay off temporary borrowing. However, the truth is this: no nation can deal with this crisis on its own. The effectiveness of the Australian government's domestic action to deal with the financial crisis will depend on the recovery of the global economy. This is a global recession, and it requires, therefore, a global response. The G20 summit in London must focus on delivering tangible outcomes in 4 to 5 critical areas, which help to lay the foundation of a long-term pathway to economic recovery: macroeconomic stimulus, restoring credit markets, support for developing countries, and reform of the international financial institutions. Macroeconomic stimulus. Governments have already acted to stimulate their economies, providing 1.8% of global GDP in fiscal stimulus for 2009. The IMF estimates that this fiscal action has supported some 19 million jobs across the G20. In other words, absent this fiscal stimulus across the G20 economies, nearly 20 million people more would be thrown onto the unemployment queues. And underlining the importance of global coordination, the IMF estimates that this fiscal action will be 50% more effective because it has been coordinated. In addition to fiscal action, central banks around the world have aggressively cut interest rates and shown a willingness to explore the full range of monetary policy instruments to tackle the crisis. Taken together, this action represents the largest and most synchronised macroeconomic policy action the world has seen in our lifetimes. Let us underscore that fact. It is an almost unprecedented response to an almost unprecedented crisis. For the future, countries must be prepared to do more as required. As I said before, the IMF has estimated that a further stimulus of 2% of GDP will be required for 2010. Consistent with this, finance ministers meeting in Britain last week committed to take, and I quote them, whatever action is necessary until growth is restored. Toxic assets. In addition to macroeconomic support, we must act to address the root cause of the crisis, in particular the toxic assets that currently lie on the balance sheets of systemically significant banks across the world. Until this problem of toxic or impaired assets is resolved globally, there is little hope of restoring normal credit flows and restoring global growth. The IMF has estimated that without action to address bank balance sheets, global credit growth in 2009 could fall by an annualised 6.1%, or a combined fall of at least US dollars 3.9 trillion. If we are to look to historical ratios between credit and growth, a credit decline of this magnitude would be associated with a fall in economic activity of around 2.1 trillion on an annualised basis. This is equivalent to a fall in global GDP of around 3.5%. Here in the US, this week's announcements by Secretary Geithner is positive and has been warmly welcomed by markets around the world. Secretary Geithner has recognised the imperative to neutralise toxic assets in America's financial institutions. His plan uses public incentives to mobilise private capital to assist in price discovery and to balance risks between the government and the private sector. Impaired assets programs will be implemented in a manner consistent with the economic and political circumstances of each country concerned. But it is important that national programs, including those in Europe, are implemented within a coordinated global framework to minimise negative spillovers between nations. Again, I would make reference to the recent meeting of the G20 finance ministers, which agreed on principles to underpin a globally coordinated approach. The principles cover the eligibility of assets and institutions, risk transfer and burden sharing, transparency and price disclosure, valuation and monitoring. Consistent with this framework, this agreed framework, a framework agreed across the G20, the Financial Stability Forum should report on the implementation of impaired assets management program by individual governments over time to help restore confidence to the overall system. To assist countries in implementing programs to deal with impaired assets, the IMF could also identify and facilitate relevant expertise in the implementation of toxic asset management programs. The IMF. In addition to action on stimulus and impaired assets in advanced economies, our third priority for the London Summit must be strong action to support developing economies given their intrinsic significance, together with their wider significance to global economic recovery. There was a view at the start of this crisis that the developing countries would fare better than the advanced countries, the so-called decoupling theory. But it is now clear that the developing countries are facing a severe and growing crisis themselves. My friend Bob Zellick from the World Bank has noted that in the advanced countries, this began as a financial crisis which spread to the real economy. But in developing countries, the crisis is moving from the real economy to the financial sector. Developing countries are facing collapsing private capital flows. Private capital flows to emerging markets are estimated to drastically fall from a peak of $929 billion in 2007 to just $165 billion in 2009. That is a big fall. In Eastern Europe, the crisis is especially severe. That region needs to roll over some $413 billion in external debt that it will fall due in 2009. IMF estimates suggest that countries in Eastern Europe will have a combined financing gap of about $123 billion in 2009 and $63 billion in 2010. Losses in Eastern Europe would also exacerbate capital needs of Western European banks. Western European banks' total exposure to the region is estimated at about $1.6 trillion. This could, therefore, represent a second wave of toxic assets rebounding onto the balance sheets of bigger Western European banks, unless action is taken. To help deal with this crisis in emerging markets, the IMF must be rapidly reformed and properly resourced. With the World Bank estimating a global financing gap for emerging economies of around $1 trillion, the IMF's pre-crisis resourcing of $250 billion is manifestly inadequate. The fund also suffers from its poorly representative governance structures and quota shares, particularly at a time when the world will call on surplus nations, such as China, to bolster the IMF's resources. It is unsustainable that Europe has 8 times the quota of China, but only 1.7 times the GDP. The current toolkit of the fund also lacks the necessary surveillance mechanisms to predict crises and lacks anticipatory rather than reactive lending instruments. Failure to address the deficiencies in the resourcing, structure and governance of the IMF risks intensification of the global recession. At London, therefore, we must work together towards agreement on a number of measures that would enable the fund to respond to the challenges that lie ahead. We should aim to at least double and, if necessary, treble the pre-crisis level of the IMF's resources. We should support the implementation of newly established policy and lending instruments to address this crisis and provide countries with precautionary financing before the crisis hits them. And we should direct the IMF to strengthen its surveillance monitoring and the reporting roles to help deal with the current crisis. While it is tempting to focus on better equipping the IMF for action in the short term to respond to this crisis, we should not ignore the necessity for medium and longer term reform as well. We must support reform of the IMF ownership structure to better reflect the economic weight of its members. And we must reform the governance and management of the IMF, including the role of ministerial oversight, the role of the board and the way in which senior management is selected. Regulation. Of course, the London Summit must also address the weaknesses in the global regulatory framework that were one of the fundamental causes of the current crisis. Recent action on this front has been positive, with the Washington Action Plan producing positive agreement to strengthen regulation of systemically important institutions and credit rating agencies, ensure remuneration does not encourage excessive risk-taking, and expand Financial Stability Forum membership to the G20. But we now need to implement these agreements against firm timelines. We must subject all financial institutions, markets and products to a level of regulation appropriate to their systemic significance. Governments could require the registration of hedge funds or their managers and the disclosure of information useful to assessing potential risks. The build-up of systemic risk can be better prevented by strengthening macro-prudential oversight and by the Financial Stability Forum coordinating the development of tools to address systemic vulnerabilities, which can be used by governments. The Financial Stability Forum was set up in April of 1999. It was born not just out of the Asian financial crisis, but the problems in September 1998 created by the failure of a highly leveraged hedge fund, Long-Term Capital Management, LTCM, which had a dramatic effect on advanced country debt markets and institutions at the time. The FSF was established to advance international financial stability by greater information exchange and international cooperation in financial supervision and surveillance. It is demonstrably an important body. It sets out 12 major standards covering macroeconomic policy and data transparency, institutional and market infrastructure, and financial supervision and regulation. In the world in which we now live, the G20 world, where advanced and emerging market economies both have economic significance and influence, we also need a body like the FSF to be inclusive and representative. Protectionism. In all negotiations next week, we must be informed by history, and in particular the lessons of that London conference 75 years ago. We must not allow the fire to spread further through new acts of protectionism. We welcome the commitment from the United States not to use domestic stimulus packages as a form of protectionism. But despite this commitment, and commitments elsewhere, the global threat of protectionism remains real. There is real concern that as US and European banks restructure, that they do not withdraw from overseas markets. We must extend the Washington standstill against protectionist measures for a further 12 months. We must endorse continued monitoring by the WTO of national protectionist measures. We must prevent financial protectionism from becoming the Smoot-Hawley tariff of our time. There exists a strong political will on the part of most governments because practically all governments are seized of the seriousness of the current challenge and the need for coordinated action to deal with the challenge. The G20 countries nonetheless have a long way to go over the coming week in negotiations that lie ahead of us, and there is certainly no guarantee of success. Progress in the lead up to the G20 and progress subsequent to the G20 summit will inevitably be in stages. We must commit to measuring progress and to advancing further measures as they become appropriate. Together, the international community must craft and construct the content and the narrative of a global economic recovery strategy. Because the truth is, we are all in this together. I've said before that confidence cannot be created by talk. In the words of Franklin D. Roosevelt in 1933, we can't ballyhoo ourselves back to prosperity. Instead, we need to create what I've described as a rational basis for confidence. If we can reach agreement on a substantial program of action, dealing with both the causes and the effects of the current crisis, and reinforced by a credible program of work for the future, we can provide consumers, businesses and markets with a rational basis for confidence, optimism and hope. The importance of confidence in an economy is well recognised. Confidence is critical to restoring demand and returning the economy to growth. It is part of our role as governments to help shape the prevailing narrative for global economic recovery and to restore confidence through a clear sense of global and national direction for the future. Schiller and Akerlof, borrowing from Keynes, describe this as taming the animal spirits alive in our economy, where national decision-making, reinforced by optimal information flows, have, for many, ceased to be persuasive. Given the scale of the collapse and the interconnected nature of financial markets and real economies, confidence cannot be restored by single national action alone. Coordinated global action is required. The G20 meeting in London next week is an important vehicle in helping to restore global confidence. Success will be difficult, and success may only come over time. In the midst of a crisis, we are in danger of markets and governments being overwhelmed by complexity. At its core, however, the challenges we face are clear for all to see. The policy responses also are relatively clear. Political will is what is needed most to prosecute that course of action. It was US leadership some 60 years ago, following the Second World War, that helped to build the international institutions of the post-war global economy. Franklin Delano Roosevelt's leadership helped to produce the Bretton Woods Agreement of 1944, and a financial architecture that has served the world, albeit not without problems, for the past 60 years or so. US global economic leadership is once again being called forth, and the US is responding to the call. Now, amid a crisis of historic proportions, it is time to reform the global financial architecture to meet the complexity and the interconnectedness of the 21st century, and so lay the foundations for sustainable, long-term economic recovery. I thank you.